Welcome to Morphic Labs, and today we are going to be diving into the retail quant structural edge, a mathematical analysis of the capacity constraint and the nimble trader advantage. We are going to be continuing where we left off, where the last video was chapter 4. Now we're at chapter 5, quantitative framework, the nimble edge. But before we get into that, do me a favor, hit the subscribe button if you want to keep up with more content like this. And if you're interested in increasing your market intelligence, I have a free market microstructure and trading system course that will walk you through the foundations of market structure, the mechanics of trading, market data and analytics, plus an advanced market aggregation course that will walk you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, order flow and microstructure aggregation, event-driven and hybrid methods aggregation, and implementation and selection criteria. The link's in the description if you're interested. You just gotta sign up to be a free member to get access to all of this information to yourself. Now, let's get into it. 5. Quantitative framework, the nimble edge. Information asymmetry reversal. Traditional finance theory posits that institutions possess an information advantage. In the context of micro-alpha strategies, this relationship inverts. The information paradox. Institutions know more about macro trends, earnings estimates, flow data, analyst consensus. Retail quants know more about microstructure patterns in markets, niche asset behavior, cross-market dislocation visible at institutional scale. The reversal, in the micro-alpha space, institutional knowledge is either irrelevant, signal is microstructural, or already priced, macro consensus. The retail quant's granular execution level knowledge becomes the superior information set. This can be formalized through the concept of effective information. I sub effective equals I sub raw times F sub actionable of A times F sub timely of tau, where I sub raw is the raw information content, F sub actionable of A decreases with assets under management, larger funds have fewer actionable instruments, and F sub timely of tau decreases with execution latency tau. For micro-alpha strategies, the limit of I sub effective of institutions is much less than the information content of retail. At least is much less effective as the AUM tends towards a sub capacity, right? So as the limit of the assets under management increases, essentially institutions' information content becomes less effective. 5.2 Strategy capacity analysis. The capacity of a strategy is the point at which the expected net returns equals the risk-free rate. For a strategy with expected return mu, volatility, sigma, and cost function C of A defined as A star equals C to the negative 1 times mu, difference R sub F, difference sigma times Z sub alpha over the square root of N, where R sub F is the risk-free rate and Z sub alpha is the confidence level and N is the number of independent bets. Table 10. Strategy capacity analysis. Our strategies are small cap, stat up, crypto pair trade, options vol up, cross exchange up, mid cap momentum. A gross alpha of about 45% for small cap, and at the cost at 100K is about 2%. Right? Essentially, when you plug in your expected returns, right? The expected return of 45%. You plug that into this. You let all the other variables. Because here's the thing. Most of these numbers, if you're curious, they come from this reference over here. These references, I mean, but whatever. Okay. As you can see, gross alpha about 45% for small cap startup. A cost at 100K is about 2%. Cost at a million is 8%. Cost at 10 million is 35%. Cost at 100 million is much greater than 100%. Right? And the capacity is approximately about 3 million. Crypto pair trade, a gross alpha of 65%. Cost at 100K is 3%. Cost at a million is 12%. Cost at 10 million is 50%. Cost at 100 million is much greater than 100%. And the capacity approximately 1%. Options vol up, it has a gross alpha of about 35%. Cost at 100K is 2%. Cost at a million is 5%. Cost at 10 million is 15%. Cost at 100 million is 60%. And the capacity approximately 15 million. Cost exchange up, gross alpha of about 30%. Cost at 100K is 1%. Cost at 1 million is 4%. Cost at 10 million is 25%. Cost at 100 million is much greater than 100%. The capacity about 2 million. Mid-cap momentum gross off of 25%, cost at 100K about 1%, cost at 1 million about 3%, cost at 10 million 8%, cost at 100 million 30%, the capacity about 50 million. So as you can see, if you essentially you're at 100 million, the mid-cap momentum strategy essentially will cost you less, right? Now, that's about it for today. If you found that interesting, hit the subscribe button if you want to keep up with more content like this. And if you are interested in increasing your market intelligence, I have a free market microstructure and trading systems course plus an advanced market aggregation course. The market microstructure course will walk you through foundations of market structure, the mechanics of trading, market data and analytics, and the advanced market aggregation course will walk you through advanced price-based aggregation, volatility-driven aggregation, information-theoretic aggregation, order flow microstructure aggregation, event-driven hybrid methods, aggregation, implementation, and selection criteria. If you're interested, the links in the description. They post basically free. And that's about it for today. And I am out. Bye.